Hi, this is Barry Brooksby. Many people don't realize the amount of fees that they are paying in their qualified plan, a 401k, a 403b, an IRA, or similar qualified plans, and even straight mutual funds. So what I want to show today are some of the issues with fees and how the fees can erode up to half of someone's account portfolio. So I'm going to start off really simply here, and let's assume that this individual is 35 years old and they want to save money for 30 years, and they're going to get to the point of having $1 million. What would it take a person to save every year to accumulate $1 million if they were just putting this cash under their mattress? For 30 years, they would need to save $33,333.33. And at the end of a 30-year time frame, under their mattress, they would have $1 million of cash. Now, I'm using this example because it's very simple to see what's happening with fees. Now, this is cash under a mattress that over 30 years became $1 million. There's no interest that was earned on this, just straight cash under a mattress. Now let's assume that this same money had been put into a 401k or a mutual fund, and there were a 2.5% fee that would have been charged on this money. We're looking at this now as if there were no interest earned. So a 2.5% management fee drops the account to $691,000. That's over a 30% reduction in the overall account value. Obviously, when people put money into a 401k or a mutual fund, they're expecting some type of rate of return. But what's interesting about this is that the more interest or the higher rate of return that a person earns, the greater the fees. I'll show you what I mean. So let's assume that this person earns a 6% rate of return every year, year in, year out, which hasn't happened, but let's look at it. So now we see that the total account value grows to $2,793,000. And if we add that same 2.5% management fee, the account now drops to $1,735,000. So let's do the math. 1,735,138 divided by the number without the fee was 2,793,389. And we minus that by 100. Now we're talking a 38% reduction in the account value. So a simple 2.5% management fee over 30 years resulted in a drop of $1 million. This person lost $1 million because of management fees. So remember 38%. Well, what about an 8% return? What if a person managed to get an 8% return? Again, we're going to take off the management fee. That account would have grown to just over $4 million. With the management fee, we're at $2.45 million. So let's do the math. 2,455,781 divided by, without the management fee, 4,078,195. Now the account has eroded by 40%. As you can see, the higher rate of return, there is a larger eroding factor because of the amount of fees. And why is that? Well, a higher rate of return means there's more earnings. If there's more earnings, that means that there's a greater amount, a greater volume of fees that's being charged. It's still the same 2.5%. But if you notice here, In the very first year, the 2.5% fee, it only took away $900 in that year. And then the second year, the 2.5% fee took $1,848. But by the time you get down to even the 15th year, there's $19,000 of fees that are deducted from the account. And then you get down to the 28th, 29th, and 30th year where you have over $55,000 every single year that are being charged in fees. This isn't just happening one time. This is happening every single year. And at the end of this 30-year time frame, you see here $741,000 in fees. Then you tack on top of that lost opportunity cost. In other words, what could you have done with that money? That factors into your losses as well. Now, some of you may be saying, well, Barry, you're using an outrageous fee. It's not 2.5%, it's only 1%. Well, let me shed some light on this. They may disclose 1% or 1.5%, but I'm going to show a couple things here that will completely tell the truth that in reality, this 2.5% fee, this is low. I should be showing a 3.5% to 4% fee. That's reality for most people. Let me give you an example. This is an article that was on Forbes.com, and it was titled "The Real Cost of Owning a Mutual Fund." The author of the article talks about the expense ratio that's charged, transaction costs that are charged, and then goes on to talk about tax costs, cash drag, soft dollar cost, advisory fees. And the conclusion, you see here that in a non-taxable account, after all these expenses and fees, the total cost is 3.17%. And in a taxable account, the fees are 4.17%. So again, higher than my 2.5%. I also want to share just a quick clip from a story that 60 Minutes did on the fees in these qualified plans. It's less than 3 minutes, but you'll really enjoy it.
Brooks Hamilton has helped design retirement plans for some of the country's largest corporations. He says 401ks turned out to be so much cheaper than funding pensions that many companies decided to freeze their pension plans and replace them with 401ks. The decision created millions of new employee investors for Wall Street and the financial community, and they pounced on the opportunity.
If you go back and track the mutual fund growth in assets, and you track the growth in 401k plans, it looks like a railroad track leading to the sky. They are parallel tracks.
So the big beneficiaries were the mutual funds.
That's right. That's correct.
When employers began turning 401ks into retirement plans, the financial community was not shy about promoting them as such. The prospect of trillions of dollars in the hands of unsophisticated investors opened the door for all sorts of potential abuses.
The fact is that the typical 401k investor is a financial novice. They don't know a stock from a bond. And we give them a list of 20 or 30 mutual funds with really, really powerful names. You know, they sound like, gee, that's where I want to have my money.
What are generally the quality of the mutual funds and 401k plans?
Mediocre. I'm going to be real honest with you. With half the funds on the list, really dogs, what people would characterize as dogs, shouldn't be on the list to start with.
There clearly has been a raid on these funds by the people of Wall Street, and it's cost the savers and the future retirees a lot of money that would otherwise be in their account, independent of the financial collapse.
Representative George Miller of California is chairman of the House Committee on Education and Labor and a staunch critic of the 401k industry, especially its practice of deducting more than a dozen undisclosed fees from its clients' 401k accounts.
Now you got a bunch of economic wizards jumping in and taking money out of your retirement plan, and they don't want to tell you how much. You can't decipher it in simple English, and they're not interested in disclosing it or having any transparency about it.
And most of the people that look at their 401ks have no idea that these fees are being taken out.
No. Where would you find it? Where would you find these fees in this prospectus? You can look on any page you want, and when you're all done reading it, and you will find some of the fees and the commissions here, but you won't find them all, and I bet you won't find half of them.
There are legal fees, trustee fees, transactional fees, stewardship fees, bookkeeping fees, finder's fees, and the list goes on and on. Miller's committee has heard testimony that they can eat up half the income in some 401k plans over a 30-year span, but he has not been able to stop it.
In that story, you heard that many of these fees legally don't have to be disclosed. They're hidden fees, and that the list goes on and on. So 2.5% is actually conservative. If we look at a higher fee, say 3 or 3.5 or 4%, again, you see the amount of devastation done to this account. And does it seem logical that the larger your portfolio grows, that the larger the amount of the fee? In other words, does it seem all right that if you have accumulated or $1 million or $2 or $3 million worth of net worth in a qualified plan or a mutual fund, that you should be charged $73,000 a year for that fund to be managed? It just doesn't make a whole lot of sense, yet we overlook it because it seems like such a small fee. But in reality, it can erode up to half of someone's portfolio. There are other stories you can look at. This is not just exclusive to 60 Minutes. Bloomberg has done stories on this. Dalbar has also done studies on this. They're an independent third-party company that looks at fees and what the stock market has done over time. So understand what's happening with fees and the devastation that they're causing to Americans' retirement savings. There is a solution. You don't have to subject your retirement savings to these kinds of fees. For more information, visit us at wealthoptimized.com.